Good morning, everybody, and welcome to our weekly think tank for May 3rd. My name is Carl Capilingua, and I'm the market analyst over here at Think Markets Australia. And it's a pleasure to be with you as we delve into everything that happened last week and look ahead to the week that's coming up. The Think Markets difference before we get started is substantial. $8 flat rate trades, your own holder identification number, no hidden platform fees or subscriptions. And the thing I like the best, you get to speak to a real person straight away. None of those pesky chat windows that the other brokers have. Hey, if you're new to the Think Markets family, you can join us before June 30 and also get your first 5 trades for free. There are always terms and conditions on these types of things, so head to the website for more details. Note terms and conditions on today's presentation, just all fantastic content. We'll kick off with a look at the crypto world, then have a look at the market moves from last week, see what's going on the macroeconomic data side of things. Check out a focus sector this week, and I think you'll like this one. See what the brokers are saying about Australian stocks, see if there is any value in the Australian market and what's happening on the technical side of things, and then have a look to the week ahead. Okay, crypto world at the moment, very exciting. We know Bitcoin's been going gangbusters at the moment, but the one I think to watch moving forward is going to be Ethereum. Now, Bitcoin is the world's largest cryptocurrency by market capitalization. Ethereum is number 2. Currently, Bitcoin's about 3 times bigger than Ethereum. Bitcoin is strictly a unit of exchange, a way to potentially, if you want to, pay for things, a store of value. Ethereum is a little bit more complicated than that. It's basically a network. It's an ecosystem in which you can build a bunch of decentralized finance applications. That is, applications based upon blockchain technology. It also has its own blockchain currency called Ether that trades on that network. So, long story short, there are many similarities, but Ether is a little bit more future-proofed than Bitcoin. There's a few more things you can do with Ether. And potentially for that reason, we've seen Ethereum outperform Bitcoin over the better part of the last 12 months. Now, Bitcoin topped out at about 61 times the Ethereum price and steadily fallen to around about 20 times the Ethereum price. And that's obviously despite Bitcoin rising over that time. We've just seen quite a significant breakdown on the chart of this comparison below that 22 zone. And where could it go? It could potentially come down to potentially 10 times, which if Bitcoin stays around its current level of 60,000 could mean an Ethereum price of, it's currently at 3,000, right? So if we came from 20 to 10, that would be times 2, which would equal 6,000, which of course is 10 times, gives you 60,000. What if Ethereum managed to get itself to the same capitalization as Bitcoin? We said it's roughly a third at this point in time. So what if we said 3 times 3,000? You could end up with 9,000 potentially on Ethereum, and they would have the same market capitalization. So I think there's plenty of upside here. I think you should probably go out and have a look at Ethereum. Of course, at Think Markets, we're not just a stockbroker here. We do give you access to a bunch of cryptocurrencies, Bitcoin and Ethereum included. So if you haven't thought about it yet, certainly have a think about it and get on to your Think Markets advisor and have a chat about it. Okay, let's have a chat about Australian shares last week. Not a great week, down about 0.5%, but most of those falls occurred on Friday. Friday, we were down about 0.75%, so if not for that one session, we would have eked out a gain. Worst performing sector, the gold sector. I think there's some disappointment there, not just on the fact that gold prices were down during the week, but given that they didn't really kick on from what was beginning to be an interesting little rally there. So I think maybe some of those gold investors getting ahead of themselves. There was also some news out on some Barbara mines, which fell pretty sharply and probably didn't help the sector number there. Apart from that, technology sector, definitely an underperformer also. Tech stocks in the US underperforming and I think dragged down the local sector here. Staples, Coles had a good quarterly report. Woolworths not as well received by the market. The price of Woolworths fell quite sharply. It is a big weighting in that sector, and therefore I think that's the reason why we've seen a big fall there. Apart from that, a pretty quiet week all round. Having a look at the chart for the ASX 200, and it is still onwards and upwards from here despite Friday's disappointing close. Overall, I'm still pretty happy with the technical performance of the market and the trends I'm seeing. I think it's pretty natural to see a bit of supply coming around, a bit of uncertainty around these all-time highs, and whilst the trends remain intact, I don't think you should panic too much at all. So happy to call this one onwards and upwards from here. But given what happened on Friday, I am just watching it that little bit closer. Also watching quite closely Asian markets. They were disappointing last week. US markets were pretty flat. Friday's falls took the shine of what would have been a pretty decent week. And we talked about the underperformance of technology and small capitalisation stocks also. Russell 2000 down for the week too. In Europe, it was pretty flat and a little bit mixed. This is the S&P 500 chart. It is still the stairway to heaven with this sort of bottom left, top right move. A well-established short-term uptrend, just a magic long-term uptrend. The candles are predominantly white, as you can see, and I do watch out for these little black ones that come in, but I don't think they're as sinister as, for example, that one there. That one's actually pretty sinister, but didn't turn out to be doing too much. That one there. So all good for now. Happy to back this one to the upside. This one here, which is the Nasdaq, is less positive because we do have a few more black candles, so they're having a little bit more of an impact on the market here. Again, not surprising that we find supply coming in at previous all-time highs. We actually took that high out during the week. You can see 14212 versus 14176. We just couldn't hold on to that high. Look, whilst the short-term trends and long-term trends remain up, and the price action still remains pretty good with higher peaks and higher troughs, although they are starting to overlap a little bit. I'm still happy to back this one to the upside. Also very happy to back to the upside base metals prices at the moment because they had a huge week, led up 4%, nickel up 7.4%, tin up nearly 6%, zinc, copper, the list keeps going there. Good to see copper going up. They call it Dr. Copper. It's a great indicator of global market growth. Iron ore took a little bit of a breather. It's had a great run through April. And as we mentioned earlier, gold not really living up to some of the promise that it had shown in prior weeks. And just having a quick look at the nickel chart, we saw that one was up the most out of those base metals. This big drop here was an announcement by the world's largest steel producer, Tsingshan Holdings, who said they'd cracked the Da Vinci Code on this process to convert lower grade nickel pig iron into higher grade nickel matte. That's the nickel that's used in electric vehicle batteries. And it was the big hope for the nickel market more generally that, this demand coming from electric vehicle batteries was going to grow. So, of course, if you can get the good stuff from the common stuff, that is a big impact on the supply side. So more supply, even if demand does grow, potentially prices have to come down. We did see prices fall from just under 20,000 down to 16,000 last week. We saw a rather large bounce back, though. Couldn't see anything really on the fundamental side to explain why that occurred, but certainly on the technical side, we can see it bouncing off this key dynamic support zone here, and certainly, the other base metals were quite solid. So good to see that for local nickel stocks, and we'll talk about a couple of nickel stocks in a second that you might want to look at. Continuing on with the market moves from last week, we saw energy prices rise nicely during the week, but the Australian dollar fell back as the US dollar rallied. That one's a little bit concerning because the US dollar is typically seen as a flight to safety instrument. And we don't want investors flying to safety right now. We want them to be taking risks and being excited about global growth going forward. So that is an interesting one there, and we'll continue to watch that closely. Bond yields were on the rise as we had some really strong data. We'll talk about that data in a second, but just noting for now, Australian bond yields, yes, we're up a little for the week, but still at the bottom end of that trading range, so that's a positive. US yields moved more sharply higher on the back of some really strong data in the US, but just tailed off on Thursday and Friday, so that's encouraging. Again, in this zone here is fine. Okay, as long as bond yields stay in here, that's great. If we get up here, that's not good. And if we get down here, that's not good either. So the old Goldilocks analogy, I think, applies here. Up here, things are running too hot. The economy's running too hot. There's too much inflation out there. Down here, the economy's running too cold. Okay, flight to safety. People are buying bonds again. In here, just right. That's where we want to be for stocks. Talking about where we want to be for stocks, we don't want to be following this move here, which commences in about 2 weeks' time, according to what happened last time in the GFC. This chart represents how we're tracking this crisis versus last crisis, and we've set it to a base of the exact low of each of those bear market moves. And they're uncannily similar, aren't they? They're frighteningly close. And I'll let you press pause and have a look at the ups and downs, the ebbs and flows of this. And it's just a bit of fun. Don't panic. The market is not guaranteed to crash in 2 weeks like it did back in the GFC or post-GFC. We don't know what's going to happen. But hey, you never know. What could crash the markets? Well, certainly a big spike up in inflation could hurt the markets. Interest rates could go up and that would hurt the markets as well. We're not seeing a lot of inflation in the Australian economy at the moment. So this was the Consumer Price Index for Australia, came in at 0.3%, which was better than expected and less than the last reading. And I think that's a pretty neat downtrend there. So that gives the RBA plenty of flexibility to continue the course with stimulating the Australian economy without too much fear that that's going to flow through into inflation just yet. Having a look at data out of China during the week. Now, it's the way we read this. We've got PMIs here, which is a broad survey of an industry. So we've got the services industry and the manufacturing industries represented here. And the way you read this is you go services industry number versus what the market was expecting. So we can see that the services PMI, this official data from the Chinese government, worse than expected on the services sector, okay, and also down from the previous reading. And then manufacturing also worse than expected and also down on the previous reading. And that speaks to, you know, a general slowing in the Chinese economy, at least certainly the data slowing over the last month or so. More broadly, over the last 6 months, it's been going gangbusters. So that is interesting in itself. Obviously, China being our major export partner, it is important for our local market. Now, that's the official government data. This is a private sector survey. That was a little bit different. Certainly, services number came in less than expected, okay, but it was up on the previous number. And the manufacturing, yes, actually, in fact, so better than expected, I should say here, and up on the previous number there as well. So some conflicting data there, but both surveys were fairly consistent in saying that manufacturing output is being negatively impacted by supply side constraints, the ability for businesses to get the materials, to get the labour they need to produce whatever it is they have to produce to send to the next business, to then send to the next business or send to us, okay? And that was reflected also in some of the US data. Durable goods orders, a very important data release. Big ticket items. You don't go and buy a big ticket item unless you're confident in your situation going forward. And this measures right across the US economy, all the way from defence spending, government spending, all the way down to business and us consumers. It was certainly up from the previous reading, which was negatively impacted by the bad weather they had, but it was well below market expectations. And most of that was due to a big decline in aircraft part orders, which is not surprising given what's going on with aircraft travel at the moment. So we'll just take that one with a bit of a pinch of salt for now. Positive reading from the Conference Board on US consumer sentiment at the moment. Current situation showed the biggest jump. It was about a 30-point jump. Because we've got vaccines in play, we've got the economy reopening, we've got employment ticking up, so that's helping the current situation. A smaller jump in the expectations index, so that's a little bit of a concern, but overall, pretty happy with the way that one came out. Also happy with the way the FOMC moved. That is the Americans' version of our Reserve Bank. They decided to keep the interest rate there on hold at around about 25 basis points, and no word on tapering their asset purchases. So that's good news. Also, in their commentary, they said that unemployment was still way too high. There's still too much slack in the labour market. They need to get that down. They need to continue to stimulate the economy to grow jobs. And until they saw significant growth in wages, they're not too worried about inflation. And I've got a data print about that in a second. GDP came in better than expected, but mainly due to a comparison. So if we go back 1, 2, 3, 4 quarters, obviously if this one's down a lot, you don't need to do too well for this one to be up a lot. But still, it's definitely a step in the right direction for the US economy. Chicago Purchasing Managers Index, we know what the PMI is now. That was a huge beat on expectations and on the previous. But the back orders index popped about 16 points to its highest level since 1973. And the word supply constraint was used many, many times. Businesses can't get the materials, the labour they need to get stuff out there. And what happened in 1973? That was the last major supply shock that the world experienced back in the oil price crisis. So it just speaks to the magnitude of this crisis right now and its potential impact on the global economy. And I think maybe also that's why stocks faltered last week. There's just a few nerves just jangling a few nerves about what some of this means going forward. Pardon me, we had an unnecessary skip back there on the slides. Weekly unemployment claims better than expected. The trend is definitely your friend on that one. Having a look at personal expenditure, so how much we're spending and how much we're making. Big jumps. This was on the back of stimulus checks hitting bank accounts. No surprise there. Expenditures were up, also bouncing back from the bad weather that they experienced the month before. So no surprises there. As you can see, they're all pretty consistent with expectations. Not consistent with expectations was the rate of inflation measured by the PCE price index. Now, this is the Federal Reserve's preferred measure of inflation, came in at 0.4 versus 0.3. Look, it is worse than expected, and it's definitely rising. So we don't want to see this too much more. We're expecting a short-term spike in inflation, so we will have to keep an eye on that very closely. And also a close eye on this, because this is wages growth. So wages growth up 0.9% quarter on quarter. That's more than expected, and certainly up from the previous one. And if wages growth starts to get out of control, then we are going to see some pretty significant inflation in the economy, and central banks will have to react to that. Part of the reason for these supply side or these increases in supply side costs is because basic materials are going up in price, and they're going up because of their own supply side constraints. Copper, the biggest global producer of copper, is Chile, and they're having some tough times at the moment with COVID. Chile production is down, global copper production is down, and demand we know is high coming out of COVID and this new economic recovery. So prices are spiking, and that is contributing to supply side inflation as well. If you want to be involved in the copper space, I think this is the best way to do it. Oz Minerals, bottom left, top right on the chart. A little bit of a pullback here to support, which is a good thing. I think that's where you want to get it. You want to get it in these support zones. You don't want to buy it up here. You'd rather buy it at that cheaper, quote unquote, cheaper trend-based price. The long-term trend is fantastic. Happy to stick with that one. The next one, nickel. We've talked about the nickel charts. I won't talk about that any further, but we'll talk about a couple of nickel stocks, which I think look very interesting. So IGO, they are a nickel producer. They also have some exposure to copper as well, which is very interesting in itself, and recently acquired some exposure to lithium. So they're really moulding themselves. You think about what goes into an electric vehicle. You need copper, you need nickel, and you need lithium. So these guys are trying to position themselves as an electric vehicle play. And look, I think if they get through 776, I mean, this basing pattern here and this move here, the next move could be substantial. I don't want to pay the current prices though. I'd much rather get it if it pulls back into this zone. This is the buy zone for me, around that 727.30. I hope it gets there. If it doesn't, then you might have to chase it, but you'd have to make that decision. Nickel mines, I don't think you have to chase this one. The good news is it is pulling back, not just to the short-term zone, but more really to the long-term zone here. If you're less risk averse, well, I don't know what the right word is, if you're a bit more of a risk taker, you can buy it in that zone on the basis that you're expecting it to hold. If you're more risk averse, I would wait for confirmation that this zone is held. So moving out of the zone, coming back, testing the zone here with some nice candles. What would a nice candle look like? It would look like that, or it would look like that. Okay, and that would be the time to get involved and take advantage of the fact you're not paying up here. Okay, but you're still getting it in the long-term trend. A very low-cost nickel producer, nickel mines, and very, very cheap on the PE, and it also pays a dividend as well. Having a look at tin, the tin market is the tightest market out of all the base metals. There's very little tin around. We're talking 1 or 2 days supply in London Metals Exchange warehouses and dropping. The biggest producer globally of tin is Indonesia. Again, COVID is a problem there. Now, many of these things will back out in the longer term, but we're probably still years away from getting back to normal. So potentially there's an opportunity here. Unfortunately, we don't have many tin producers in Australia, and this is really the only play out there, and this one really only has a 50% interest in the Renison Tin Mine in Tasmania, and operationally it's somewhat of a train wreck. Having said that, it's still the play. So if it breaks through 25, and it is actually breaking through 25 today, that's when you become involved. A nice base pattern here, and again, sort of measuring the move higher, looking at that. Okay, broker moves. I'm going to move very quickly here because I'm behind on time. I'll suggest you press pause and have a look at those. I will also have the broker moves review coming out shortly, where I go into great detail as to the reasons for these broker moves. These are the upgrades and downgrades. These are the top 10 price increases and decreases, top and bottom respectively. And moving into the value in the Australian market now, the 1 year forward PE for the ASX 200 is at 18.61. Now that fares better than the global developed markets PE of 19.97, but I do note that the spread is narrowing through here, so we are becoming less competitive on that basis. Part of that, I think, is to do with US quarterly earnings season, which we're in the middle of at the moment. About 60% of stocks have reported. About 86% of those have beat analyst estimates. So analysts start to ratchet up their expectations for earnings going forward. Remember, PE, right? If this goes up, then the PE goes down. And that's what we're seeing here. So that is a bit of a concern for the Australian market. We're less competitive. Obviously, we need to have our full year earnings season before we can get potentially some of those updates coming through, and that won't occur until after June. Having a look at where the value is in the Australian market, material sector looks cheap, and that's good because we talked about a bunch of material stocks today. Next cheapest is the energy sector, followed by the financials, but I wouldn't say they're screaming value. Certainly not screaming value at the moment is the information technology sector with a PE of 62, eye-wateringly high, but it's not as eye-watering as where it was. I think it got to pretty close to 80 there a couple of months ago. Having a look at the technical picture for the ASX 300 this time, so slightly broader look at the market. And what we're measuring here is the performance of each stock versus its 5, 10, 21, and all the way out to 252 period exponential moving averages. Now, 5 periods represents 1 week, 21 periods represents 1 month, 126 represents 6 months, yes, and 252 represents 1 year. So we're seeing where the stock is in relation to its 1 week, 1 month, so on, up to 1 year trends. What we'd like to see is the vast majority of stocks participating in the uptrend, okay? And that just means a high percentage over here. So at the moment, only 40% of stocks, so a minority of stocks, are above their 5-period moving averages, above their very short-term trends. It's only until we get to really sort of our 2 months out and onwards that the majority of stocks are participating, and that is a little bit concerning for me. The best case sort of scenario is that we have a very flat line. And you can see this light green line here, which is what we were pre-COVID at the all-time high. So the best it ever was. And you're around about 2/3 of stocks participating, and it's very flat across the curve. We're up from where we were a month ago, but we are slipping from where we were just a week ago. I need to watch this quite closely because I want to see more stocks participating than there are right now. We'll participate in the Reserve Bank statement this week. What's going to happen with interest rates, we'll find out on Tuesday. Apart from that, pretty quiet week. ANZ job ads out shortly if they're not out already by the time you've viewed this presentation. Looking abroad, scratch everything else. This is the big one. Non-farm payrolls on Friday, US employment data, and I'll let you press pause and check out some of the other ones. That's it for today's presentation. Thanks for joining me. You can catch all of our other news updates in our market news section of the website, or if you like, you can follow me or the Think Market handles on Twitter. If you'd like to register for our upcoming webinars, head to the webinar section of the website, and tomorrow we'll be doing a fundamental analysis refresher. Definitely tune in for that. The week after, you can bring your portfolio to the table and ask me about them and ask the experts, and then we'll continue our top 3 series on the 18th of May with top 3 stocks under 30 cents. I wonder if Metals X is going to be in there. The disclaimer before I leave you says that everything we've discussed today is general in nature. Don't forget, we are a regulated Australian broker. We do have some products that could see you lose more than your deposit. So make sure you read this disclaimer carefully, or if you have any questions at all, please give us a call. It's been a pleasure chatting with you this morning. All the best for your trading. Until we catch up again, bye-bye for now.